In September of 1958, a bank mailed 60,000 fully active credit cards with no application, no credit check, and no approval process of any kind directly into people's mailboxes in one American city. Strangers, teenagers, people who had never once asked for credit in their lives. All of them opened their mail one day and found a working line of credit for the equivalent of several $1,000s sitting in an envelope. The bank called it the drop. Within a year, fraud and unpaid debt had spiraled so far out of control that the executive who invented the idea was forced to resign in disgrace. And yet, somehow, that reckless experiment became the direct ancestor of a card sitting in your wallet right now. Here's why this matters more than it might seem. For most of history, buying something you couldn't immediately pay cash for meant walking into a bank, filling out paperwork, and being personally judged, in person, by a loan officer who decided whether you were trustworthy enough to borrow. The credit card quietly replaced all of that with a small plastic rectangle that just works, almost everywhere, instantly. But that convenience was never inevitable. Banks spent years actively avoiding this idea, viewing consumer credit as beneath them and far too risky to touch. This is the story of how the credit card actually got built, why the industry's own funding legend turns out to be a myth, and why that bank that finally cracked it nearly destroyed itself doing so. Before any of this existed, quote-unquote buying on credit meant something much smaller and much more personal. Local shops kept running tabs for regular customers in ledger books. Some department stores issued their own single-store charge tokens or cards usable only in that one store. If you needed to finance something larger, a car, an appliance, you went to a bank, applied for an individual loan, and waited for a loan officer's judgment. There was no single card that worked everywhere. Every merchant ran its own separate, disconnected system of trust. The story most often told about how this changed goes like this. In 1949, a businessman named Frank McNamara took clients to dinner at a Manhattan restaurant, reached for his wallet when the bill came, and realized he'd left it at home. His wife had come to bail him out. Mortified, McNamara supposedly vowed never to be caught without a way to pay again, and dreamed up the idea of a single card that could work across many restaurants billed monthly. The following year, in February of 1950, McNamara and his lawyer partner, Ralph Schneider, returned to that same restaurant and paid the bill with a small cardboard card. The company called this the First Supper, and it became the founding myth of Diners Club, widely credited as the world's first general-purpose charge card. Diners Club grew fast. Within its first year, it had roughly 10,000 members among New York's business elite and dozens of participating restaurants and hotels. It wasn't quite what we'd call a modern credit card. The full balance had to be paid off each month, so it worked more like what's now called a charge card. But it proved something the banking industry hadn't yet taken seriously. People wanted one card, one bill, and freedom from carrying cash. Here's where the story gets more interesting than the underdog invents convenience narrative usually lets on. For years after Diners Club took off, the major banks mostly watched from the sidelines instead of jumping in. Consumer credit at the time had a reputation problem inside the banking industry. Lending money to businesses backed by collateral and financial statements was considered respectable, careful banking. Lending small, unsecure amounts directly to ordinary individual consumers with no way to fully verify who'd actually pay it back was viewed by many bankers as sloppy, high risk, and frankly a little beneath a serious institution. Diners Club and its early rivals were travel and entertainment cards aimed narrowly at wealthy business travelers who could be vetted individually. Nobody had figured out how to responsibly extend that idea to the general public. That hesitation is exactly what makes what happened next so wild. Inside Bank of America, an executive named Joe Williams became convinced that a mass-market credit card could work. But instead of a slow, cautious rollout with careful applications and credit checks, his team designed something almost unbelievably aggressive. Mail fully active, ready-to-use credit cards with real credit limits attached directly to tens of thousands of people who had never applied for one. In September of 1958, Bank of America tested this in Fresno, California, deliberately chosen because it was a mid-sized, self-contained market where the bank had already had strong existing relationships, and because if the experiment blew up, the fallout would stay relatively contained and out of the national spotlight. Roughly 60,000 Fresno residents received a fully active Bank Americard in the mail, each with a credit limit in the hundreds of dollars. Real purchasing power dropped into people's hands with no application, no interview, no credit check whatsoever. It's now remembered in the banking history as the Fresno Drop. The early results looked promising. Merchants were signing on, and the bank quickly expanded the drop to other California cities. But underneath that fast growth, the experiment was quietly unraveling. Handing out live credit with no vetting process turned out to have obvious, predictable consequences that the bank's own team hadn't planned for carefully enough. Delinquency rates, cardholders simply not paying what they owed, climbed past 20% in some estimates. Fraud spread quickly, since a card mailed to an actual address could easily be stolen from a mailbox by someone who wasn't the intended recipient at all, and then used freely before anybody noticed. Many recipients, receiving a card they'd never requested, didn't fully understand the repayment terms they were suddenly bound by. By the end of 1959, those losses were significant enough that Joe Williams, the executive whose idea started it, resigned from the bank. What was supposed to be a triumphant proof of concept had instantly become, for a while, a cautionary tale inside Bank of America about just how expensive a badly controlled trust experiment could get. And yet, despite the chaos, the underlying bet turned out to be correct. Once Bank of America tightened its processes, adding actual applications, actual underwriting, and better fraud controls, the core idea held up. A single widely accepted card tied to a revolving line of credit was something an enormous number of ordinary people genuinely wanted. Bank Americard kept expanding, eventually licensing its system to banks outside California, and by the early 1970s, it had been restructured into an independent bank-owned network with a new name, Visa. A rival group of banks did something similar around the same time, eventually becoming MasterCard. The reckless, half-controlled experiment that once nearly sank a career had become, within about 2 decades, the backbone of an entirely new global payments industry. Here's the detail that rarely makes it into the tidy version of this story. The founding legend everyone repeats about Diners Club, the forgotten wallet, the humiliating dinner, the vow to invent a solution, was, according to Diners Club's own press agent at the time, simply never true. He later stated plainly that the story had been invented for publicity, a clean, relatable myth to give a fairly ordinary business decision a much more compelling origin. And the Fresno Drop has its own quieter irony. The event, now celebrated in banking history as the bold visionary birth of the modern credit card, was, at the time, close to being remembered instead as a reckless mistake that got a promising executive fired. The line between quote-unquote visionary founding story and cautionary tale turned out to be thinner than either company's official history usually admits. Often decided less by the soundness of the original idea and more by whether the mess that followed eventually got cleaned up in time. The lesson here really isn't about plastic. It's about how financial history gets tidied up after the fact. The stories companies tell about their origins are almost always cleaner, more flattering, and deliberate sounding than what actually happened. Real financial innovation, it turns out, often looks less like a single brilliant insight and more like a series of messy, high-risk experiments, some of which nearly ended careers that only look inevitable once you already know how the story ends. That's worth remembering the next time an origin story sounds a little too perfectly packaged. If this video made you want to take a closer look at how your own credit is actually being used, the fees, the interest, whether it's working for you or against you, that's worth a few minutes. And since most people never really check, I've added some links below to help you get started. As always, not financial advice, just financial history. We'll see you next time.